Hey everybody, Randy Patrick here with the Housing Bubble 2.0 Weekly News Report. Again, today is October the 4th. Time to touch base on what's going on in the news, and I can tell you things are picking up. A lot of stuff's happening, and there's more and more articles being written about what's going on in the housing industry across our nation and across the world. So today's topics, we're going to discuss the U.S. Affordability Report that was just released early this morning. Here comes the inventory, Manhattan housing, home builder stocks, latest mortgage rates and issues, and the global housing crisis. So let's get into it right now. Now, one of the things I want to sort of point out is a statement I want to make is the fact that the housing market is starting to fall apart right in front of our very eyes. So if you missed the last housing I guess you could say bubble, burst, and crisis, you get to see it all over again right now, as far as I'm concerned. Now, the U.S. Affordability Report was just released very early this morning. Adam Data Solutions produces this. It's the third quarter 2018 U.S. Home Affordability Report. And apparently, home prices are the least affordable level since Q3 2008. So basically, a full 10 years, a full decade ago, we are at the least affordable point than it was 10 years ago. So can you believe that? So it's kind of like that's where we really had the housing crisis come into full effect, and we're kind of at that point right now, 10 years later, which is very interesting. Now, 1/3 of the U.S. population lives in counties where buying a median priced home requires an income of $100,000 or above, which is pretty tough. And home prices are rising faster than wages in 86% of all local markets. So your wage, your increase in salary just can't keep up with the rising home prices. Thus, we have issues with people trying to purchase homes. The average wage earner would not qualify to buy a home in 84% of the counties across the country, based on a measly 3% down payment and a debt-to-income ratio of 28%, which is kind of what they kind of base their calculations on. And the most expensive locations across the country do not come as a surprise. Clearly, we know that the San Francisco area has, I think, top 5 of the most expensive locations right in there. The Bay Area of San Fran, Westchester County and Brooklyn, New York are very expensive. Southern California, very expensive. Washington, D.C., Seattle, and Hawaii rounds out the list of the most expensive places if you'd like to purchase a home. Now, again, this report is based on the third quarter of this year. Realize that we are coming off of, I think, the most peak or the highest values we've seen since the previous peak in the previous housing bubble, which was in 2006. So we're coming off of peak values. And again, this is a report that looks back, not looking forward. Now, I would expect this could change in the next quarter, maybe not be the most expensive or most unaffordable level. Maybe we'll see some dropping going on right now. And the reason being, because the next section here is called Here Comes the Inventory. And just as a quick note here, according to NAR, the National Association of Realtors, pending home sales were down 1.8% in August compared to the previous month, which was July. So we're starting to see a little bit of a slowdown here. As we mentioned, typically things will slow down as the summer wanes on, and will start to change more rapidly and drastically as the fall and winter hit. So here we go, a report from Realtor.com. The number of new listings that were present on Realtor.com in September shot up 8% year over year. And that's the biggest jump of new listings that they have seen since 2013. So about 5 years ago, we've had this big 8% jump now. This is a key inflection point, said Realtor.com's chief economist. She states that there still are more buyers in the market than homes, but now there is competition among sellers. So yes, you've got your home for sale. You're probably going to be a little more aggressive in pricing your home, or you may look at price reductions or other concessions as a means to get your property sold. This kind of means, I guess, or conveys to me that buyers will eventually start holding the cards. It's been predominantly a seller's market over the past few years, but now we see a shift in the, I guess you say, the tide of buyer versus seller. And again, buyers are still being cautious, still waiting on the sidelines. Again, you've got, still having high prices, even though more are coming on, there still are high prices, and more inventory will bring lower prices as time goes on. But 465,000 new listings appeared nationwide in September. That's almost 500,000. That's quite a bit of new homes for sale that's come on the marketplace. San Jose saw the biggest boost, I guess, as a percentage of new listings, followed by Seattle, Jacksonville, Florida, San Diego, and San Francisco. Now, sellers are betting that we have reached a peak in the market, and now they're going to rush to get it on the market and still try to get top dollar before it's too late. But we know how that goes. You get your property on the market, it's taking longer to get looks, it's taking longer to sell, the days on market are increasing, then maybe people start to drop prices and get a little nervous. So this is where it all starts to sort of chip away at the high values right now. So very interesting. But again, the point from the chief economist from Realtor.com is saying, but now there is competition among sellers. So yeah, sellers start to realize they got to sell. Redfin CEO said, if this trend holds into the spring and buyers don't come back in force willing to pay these prices, then this is a change in the U.S. economy. Because yes, everyone's banking on, I'll put my home out there right now, still at the high prices, but when there's more homes at higher prices, that creates competition, and therefore, guess what? Buyers are going to start putting in lower offers or asking for other things, and prices will eventually drop. Now, I find this interesting as well because many new real estate service companies or those that are trying to enter into the market a little differently, like Zillow, Redfin, OfferPad, Open Door, like a lot of these companies now were either doing specific real estate services, but now they're adding buying and selling to their mix. Well, now as they get deeper into the home buying and selling, they have to be careful because this could hurt them in the future, and it will also hurt their stock prices. And again, going back to the Redfin CEO, he did say to his home buying team to take it easy on the number of houses that we buy. Because clearly they see this as a starting of a market shift as well too. Because again, based on where we're at today, you set your pricing and appraisals and values are all based on the past 30, 60, 90 days comparables. So that's the history. And now we know that things are changing. So how do you predict value 60, 30, 6 months in the future? So it really is this balancing act. You got to get it right or you're going to lose. So people are starting to get a little nervous. They're not really coming out quite directly and saying it, but you can see the inflection is there. Manhattan housing issues. Well, basically Manhattan's been in a year-long correction. Total real estate for Manhattan fell 11% in the third quarter of this year compared to last year. The average sales price is falling as well too, is down over 4%. The blip, which was thought as a blip, is a year-long slump, all right? And that's because supply is increasing. Listings climbed 13% in that area, the most since 2011. The number of sellers cutting prices is the highest level since 2009. So again, back to the whole point. So people are now flooding the market going, I need to sell my home to get my top dollar before it's too late. Well, as you're flooding the home, you're looking around, you're going, okay, there's more competition. If my home's been sitting for a couple of months, what do? I reduce my price. And that's how it all starts, folks. So the top of the market was weak before and the bottom was strong, but now the market has been flipped on its head. And realize, though, that Manhattan in itself is a much more expensive market across the board, but even the lower end Manhattan and New York City pricing has started, like lower end properties have started to lose price and start cutting, and more inventory is coming on as well too. So apparently offers are coming in at 20 and 25% below list price, which is what savvy buyers do. I'm not going to pay your prices. Mortgage interest rates are up, so if I'm going to buy in today's market, I have to have some sort of concession or we'll call implied compensation from the seller to give me that, to offset those high interest rates. So it's a timing issue, right? You've had your property on the market for a number of months at a high price. I'd like to buy it, but rates have gone up the past, little bit, and I can't afford that. So, give me something that I can afford and we can make a deal. That's how it all starts. That's kind of interesting. So buyers are coming in 20 and 25% off offer price with their offers, off the list price, sorry. Home builder stocks. Interesting to note that I've not really talked about this before, but I have been following it. So new home sales fell for the third straight month. It's at its weakest pace in the past 9 months, and this is now reflected in the stock prices. So KB Homes was the, number one builder stock to lose value. They had a 3.2% decline. DR Horton was 2.6%, Pulte 2.2% decline. Toll Brothers 2%. And to sum it up, the S&P Super Composite Home Building Index is down 21% year to date and is on pace to the largest annual drop since 2008. So again, home builder stocks are taking a bit of a hit. Home building is taking a bit of a hit. Less homes are being built. Higher prices with tariffs and materials, higher land and entitlement costs, less skilled labor out there makes it difficult to buy. And as we've always talked about, as a result of all this, a lot of the home builders have priced their homes or in building in a little more expensive markets or expensive product, and therefore, there's less buyers that can obviously jump in and purchase. But the interesting thing about home builders is that they can throttle back or they can speed up on permits and things like that. So, and actual, grant like starts, like building starts, like you've agreed to buy a home. It'll take me a year. I'm gonna break ground. So they can throttle that up and down based on who's coming through the door. So they do have a little bit more control. But it's interesting to see that they're going to see the effects too. They'll see it through their stock prices, and eventually apparently some builders are offering discounts now and a lot of promotional things as well too. They'll throw in more opportunities. They'll throw in more upgrades, more things that don't really cost them that much to keep the home sales going, and realize that a lot of builders have this in a turnkey fashion. They've got their own lending arm. They've got their own title companies or escrow companies to close. So a lot of the stuff is built in where they're able to offer a full turnkey solution to a buyer and save costs along the way. But just interesting to note that now we're starting to see home builder stock prices slip. Latest mortgage rates. Well, the 30-year fixed rate rose for the 5th consecutive week. It's at 4.72%. This is a high that's not been seen since April 2011. Now, I'm going to reference what I spoke about last video, B of A calling the market out again. So basically, they felt that housing already hit its high and peak back in November of 2017, which is almost a year ago now, and which prompted a call your realtor statement. They literally said, call your realtor. Basically, sell your house now to get your price because it's going to fall. And a quote from the NAR, National Association of Realtors chief economist, said, housing is now rolling over, and what happens next could be ugly if the events of 2007 are any indication. So we actually have people now. We have major banks. We have economists for NAR and Realtor.com basically telling us that we've peaked out. We've hit the peak. Things are changing. What are you going to do about it? Get your home listed, get your home for sale. I mean, sure, there's some counterintuitive things they're doing to stimulate their own interest in the market, but I think the point is that they're calling it, and maybe people aren't listening to them. Well, I listen to them. I listen to everybody and formulate my own opinions. I like to hear what people say. And again, compared to last housing bubble burst and crisis where it was complete denial that no one wanted to believe it was actually happening, now we have people coming up front saying, ooh, we see the signs and maybe this is not going to be a good thing. So if you're looking to cash out now. And do the things you need to do before things start to snowball. So just keep that in mind. Now, we're not alone in this, so I want to point out something here. I don't really talk about this that much because primarily we're talking about the U.S. housing market because that's our focus really. But we are seeing other locations across the world other than the United States of America that are experiencing their own housing crises right now. So Hong Kong, for example, very, very expensive, one of the most bubbly or frothiest places to live in the world is Hong Kong. Home prices fell for the first time in 29 months. Now, it's a slight decline. It was like 2.5 or 2.9%, something very small. But the whole point is it starts to trend. It goes that, hey, we can't do this anymore, or the market is peaked and buyers aren't going to pay that price. Now, the Global Real Estate Bubble Index stated Hong Kong is the most likely location to suffer from the global property bubble. Very interesting. Vancouver, British Columbia up in Canada. Home sales crashed 44% and inventory soars. So sales have dropped 44% from a year ago, and there's been a 36% increase in listings as sellers are now starting to get worried and dump their properties. Now, why has this happened? Well, everyone's blaming the lack of foreign buyers, primarily the Chinese buyers. A lot of them take the money out of the country and purchase homes in the Vancouver area. And I wouldn't call this speculation. They're not trying to flip. They're not trying to speculate. They're removing the money out of their country and putting it in a safe place. And then a lot of them are their kids are going to school in that area, so the kids can live there. They can eventually move over, have a whole familiar sort of situation in the house there. So realize that that's what goes on there. So a lot of the foreign buyers have dried up. Toronto has also seen some pretty big declines over the past few months and year with respect to a glut in condos, a reduction in prices, more listings coming on the market, etc. Australia right now is going through a complete bubble bursting as we speak. Melbourne, Sydney, other locations. So if you read about that, it's quite interesting. London, so the London market apparently is 44 to 50% overvalued. It's going through its own housing crisis again as well too. And back to China. China is also experiencing some major housing issues. If you take a look at the Chinese housing market, there's a lot of overbuilding. There are cities and skyscrapers that have been built with nobody living in them. So a lot of infrastructure has been put in place, but nobody's buying. So it's it's kind of a weird situation there, but you can check that out. But again, we're not the only ones that are experiencing this. And this is, I think, a start of a global housing crisis. So think about what's going on. Check out the news, look at the trends, look forward, not backward when you purchase property, and see what you think is going to happen. So that's the scoop. So again, for me, I just say be cautious. Look one eye behind you and one eye looking forward, and do your best to predict what's going to happen in the future. But again, I think all bets are on that we are in a shift. All right. I mean, personally, we're in a bubble and we've peaked, and we're starting to come on the other side of the peak now. We're starting to see the signs of the peak starting to slide. That's my belief and opinion. Others will say that we're peaked. Others will say that we're not quite at the peak yet, depending on your perspective and what where your, we'll say, income allegiances lie, things like that. But in the end, we've seen this before. As I said before, we're at the most unaffordable level since 2008, when everything started to fall apart. So keep that in mind. All right. Once again, thank you for the viewership. Thank you for subscribers. Thank you for your comments. If you want to contact me directly, you can see my email. There's a spot there where you can click YouTube and my email pops up. So certainly send me a direct email. Easier than than me looking through all the comments if you'd like some information. So again, best of luck. Look out for the housing market, and we will talk to you next week.